Good morning. In Accounting for Partnership Firm Fundamentals, in this video we will be discussing Partners Capital Account. Partners Capital Account. No, there are many partners, and for each partner a separate capital account will be maintained. Salary allowed to the partner, interest on capital, capital withdrawn, drawing against profit, interest on drawing, everything will be recorded in the partner's capital account, and this all the transactions may increase the partner's capital or reduce the partner's capital account. Now partner's capital account is maintained using two methods. First, fluctuating capital account method. From the name itself it is clear that with each debit and credit the partner's capital may increase or decrease. Okay, partner's capital account is said to be fluctuating when their capital do not remain fixed but varies with each debit and credit. Fixed capital account, there are two accounts are maintained. One capital account which will remain fixed unless capital is introduced or capital is withdrawn. All the other transactions like salary, commission, share of profit, drawing against profit, interest on drawing will be recorded in the second account known as partner's current account. Okay, again see, in fluctuating capital method the capital will not remain fixed, but in fixed capital method the capital remains fixed and the current account change. There are two accounts in fixed capital method, whereas in fluctuating capital method only one account is maintained. We will discuss the outline of fluctuating capital account method. Here one account is maintained, one account for each partner. Okay, the format is like this. The opening balance will be recorded on the credit side. Okay, opening balance by balance BD, and in X and Y we will record the amount. If further capital is introduced by cash or by bank, when interest on capital is allowed, by interest on capital, salary, commission will be recorded on the credit side, and share of profit will also be recorded on the credit side of partner's capital account. All the transactions which is going to increase the partner's capital account, like interest on capital allowed, salary allowed, commission allowed, share of profit, will be recorded on the credit side. This will increase the partner's capital account. Whereas if partner is withdrawing money, it will be debited to his capital account. To drawing. If partner is withdrawing capital, so to cash or to bank. See, when profit is withdrawn, to drawing. When capital is withdrawn, to cash or to bank. For interest on drawing, to interest on drawing, and in case of loss it will be to P&L account. Then the credit side total and debit side total is taken. If credit side total is more, it will be written as to balance CD. There are chances that the debit side is total is more. In that case it will be by balance CD. Okay, all of you again go through this. Okay, these all items like interest on capital, salary, P&L appropriation comes from the debit side of P&L appropriation account. Okay, and interest on drawing, loss from the credit side of P&L appropriation account. Okay, next, fixed capital account method. As discussed earlier, two accounts are maintained. First, partner's capital account, and second, partner's current account. In fixed capital account, the partner's capital will remain fixed unless capital is introduced or capital is withdrawn. Drawing against profit will be recorded in the current account. Capital introduced and capital withdrawn are recorded in capital account. Interest on capital will be recorded on the credit side of current account. Interest on drawing on the debit side. For salary, commission, it will be recorded on the credit side. Share of profit, okay, these all are shown in the P&L appropriation accounts debit side. From there it will be credited to the partner's current account. Here interest on drawing is shown in the credit side of P&L. From there it will be debited to partner's current account. Then the credit side total is taken and the debit side total is taken. The difference, if credit side is more, it will be to balance CD. Current account may have a debit balance or credit balance. Okay, current account may have debit balance or credit balance, but capital account will always have a credit balance. Now let's discuss this with an example. Okay, partners capital account we have to make, and we will be using both fluctuating and fixed method. Okay, now this information is given. Opening capital is given, capital introduced is given, capital withdrawn during the year is given, date is not mentioned. Drawing during the year ended is given, interest on capital, interest on drawing, share of profit, divisible profit, and partners salary and commission is mentioned. Now we have to prepare partners capital account using both the methods. First, fluctuating capital method, we will using fixed capital fluctuating capital method, we will prepare the partners capital account. Okay, the format is here. Now you see, opening balance 4 lakh and 3 lakh on the credit side. Partners introduced 50,000 and 1 lakh rupees. Interest on capital is 25,000 and 20,000. X is allowed a salary of 36,000 and commission to X and Y 3,000 and 2,000 respectively. Share of profit is 60,000 and 50,000. Now see, this one is important. 2 drawing and 2 cash. Drawing against profit will be recorded as 2 drawing, whereas capital withdrawn will be recorded as 2 cash. 2 interest on drawing, and then the total is calculated, that is 5,74,000 minus 30,000, 80,000 and 1,250. So the capital balance is 4,62,750. In the same manner, the total of credit side of Y is taken, which is 4,72,000. From that 20,000, 70,000 and 750 is deducted. So the closing balance is 3,81,250 rupees. Okay, balance is taken. Okay, now the same question using fixed capital account method. Capital account is prepared and then current account is prepared. Now see here, opening balance of capital is given. Current accounts balance was not mentioned in the question, so we have left it as blank. Capital introduced is recorded in partners capital account, not in current account. In the same manner, capital withdrawn is recorded in capital account and not in current account, whereas profit withdrawn drawing is recorded in current account. Okay, see here the capital changed because capital was introduced and capital was withdrawn. Otherwise it would have been same as the opening capital. Now here see, commission allowed is recorded, interest on capital is recorded, salary and share of profit is mentioned. Drawing is debited and interest on drawing is also debited. The total is 1,24,000. From that 31,250 is deducted. So the closing balance of X current account is 92,750. The total of credit side of Y is 72,000. From that 20,750 is deducted. So the closing balance of Y current account is 51,750 rupees. All of you solve this question in your register and then cross check it with the solution.